In 1933, Congress prohibited banks from investing in small businesses. This is probably the largest single cause of middle-class decline and rising unemployment. If we consider the United States economy of the 19th and early 20th centuries, investors of all types, including banks, routinely provided both loans to established businesses and venture capital to entrepreneurs. There was an adequate amount of both debt and venture capital funding. The end result was a sustained period of rapid economic growth, unprecedented in all of world history up to that point in time. The pattern was most pronounced in the last 35 years of the 19th century, when the United States emerged as the world's largest and most successful economy. According to Malcolm Gladwell's 2008 book, Outliers, 14 of the 75 wealthiest people in all of world history, adjusted for inflation, were born between 1831 and 1839. They came of age in 1865. All 14 earned their vast fortunes in the United States. Adjusted for inflation, this wave of 14 entrepreneurs amassed 20 times more money than Bill Gates has. This 35-year period of enormous economic growth wouldn't have been possible if raising venture capital back then was as grueling as it is today. It was easy for entrepreneurs to raise money, and there were lots of money to be raised. This was even more spectacular when you consider that the United States began the 19th century as an inauspicious, poor, war-torn nation, isolated from any of the world's major markets by the vastness of the Atlantic Ocean. Beyond that, there was a British-led embargo adhered to by all of Europe, with the exception of France. At that time, not one of the world's 10 wealthiest people hailed from the United States. At the dawn of the 19th century, all the world's 10 wealthiest people were European aristocrats, from families who had amassed vast fortunes over the course of the previous 300 years. By the close of the 19th century, however, all 10 of the world's 10 wealthiest men and women were Americans who had amassed vast fortunes in their lifetime. Andrew Carnegie was wealthier than all the world's aristocracies combined. John David Rockefeller was richer still. In fact, adjusted for inflation, these two Americans, Andrew Carnegie and John David Rockefeller, born in 1839 and 1835 respectively, became the two wealthiest men in all of world history. Individually, each had accumulated more than 5 times as much as Bill Gates. During the 19th and early 20th centuries, the United States built numerous industries: petroleum, railroads, rolling stock, electric power, power conversion, electric appliance, automobile, heavy equipment, farm equipment, motion picture, sound recording, and so many more that are too numerous to mention. The 19th century also saw philanthropy come into vogue. Throughout this time, captains of industry, among their many other beneficial endeavors, such as the Carnegie Libraries, funded the world's finest education system that was able to give birth to American science and engineering schools. The answer to our economic problems today is to return to a time when investors of all types, including banks, can once again provide venture capital. That was the United States economic policy from when the United States was formed in 1789 until the peak of the Great Depression in 1933. For most of these years, this policy had created a megatrend of explosive economic growth. There were 2 separate depressions and numerous recessions throughout those years, but the underlying megatrend was clearly one of explosive economic growth. In 1933, the free flow of money into entrepreneurial concerns was wrongly blamed for causing the Great Depression. Banks were prohibited from providing venture capital, and the ability of people of ordinary means to provide venture capital was severely constrained. But it is unlikely that the free flow of venture capital would cause 140 years of explosive economic growth and then suddenly cause the Great Depression. Logically, the Great Depression must have occurred for reasons other than the free flow of venture capital. The exact causes of the Great Depression are still being debated among historians and economists, but the cause seems to be mostly related to inadequate systems and mismanagement at many levels. We need systems and sound management, not prohibitions against venture capital. One system they desperately need is a powerful tax incentive for venture capital investment. This would be considered good management of the economy. By failing to create adequate incentives for expansionary investment for a half-century, Congress has failed the American people. Today, we know that stock market bubbles and real estate bubbles are debt-fueled. There certainly was a debt-fueled component to the Great Depression. Bank and brokerage firms allowed people to buy stocks on margin, putting only 10% down. It is far more reasonable to think that the Great Depression was debt-fueled rather than venture capital-fueled. Since banks can no longer provide venture capital, all the real estate and tax market bubbles in the last 50 years were debt-fueled. Since taking away the bank's ability to participate in venture capital didn't stop recessions, one could conclude that something else was to blame. Debt-fueled crises occur whenever the value of a large group of margined assets suddenly drops in value, becoming worth less than the loans on these assets. There is no way for this type of scenario to develop in venture capital. For this reason, lending is more risky at a systemic level than venture capital. Falling or even stabilizing asset prices can trigger widespread defaults, causing a debt-fueled asset bubble to burst. Venture capital investments can and do fail. But unlike lending, there is no systemic trigger for mass failure as there is for debt-fueled bubbles. Unlike lending, there is no limit on the amount of money that a venture capitalist can make on their investment. In general, the enormous returns on some venture capital investments will usually offset the losses brought about by the failure of other investments. Lending, however, is not profitable enough to compensate for the widespread default that can occur when asset bubbles burst. Venture capitalists make money by liquidating their investments. As a result, they are dependent on strong IPO market. That is why it's necessary for the government to create special tax incentives for IPO investment above and beyond any incentives for buying stock in the secondary market. Today, we have a large number of systems in place to prevent the occurrence of another Great Depression. These systems got us through the grim recessionary periods of the early and mid-1970s, the unraveling of markets and the S&L crisis of the late 1980s and the early 1990s, and the economic and financial crisis of 2008-2009. Preventing another Great Depression from occurring, however, was the result of skilled and decisive management rather than radical changes in economic policy. If you look at the United States economy, perhaps from the country's founding in 1789 up to the stock market crash of 1929, it is clear the policy of allowing all types of investors, including banks, to provide venture capital worked very well. Today's situation seems to be the opposite of the situation in 1933. Today, the systems and management are good, but the policy is bad. Bad policy, failing to adequately incentivize venture capital and IPO investment, prohibiting the nation's banks from providing venture capital, and discouraging public participation in venture capital, appears to have caused an extended period of economic malaise that goes back at least 35 years. While the string of financial crises occurred in 2008, very decisive and superb management prevented this disaster from turning into another Great Depression. While superb management can give us temporary reprieve from the problems caused by bad policy, the only long-term solution is to repair the bad policy. We need to recognize that the core economic policy of the 19th century, allowing investors of all types, including banks, to provide venture capital was sound. Then we need to re-implement this policy in ways that would manage the risk associated with venture capital. But this isn't enough. We must also have strong tax incentives for venture capital investment. It should be noted that I am in no way advocating our return to the poorly managed and poorly regulated financial sector that triggered the Great Depression. I am instead advocating that we develop a venture capital investment program that has the best features of both the 19th and 20th centuries. When there is enough venture capital, the economy will self-organize so that enough growth businesses are started to offset the job losses and declining revenue that naturally occurs as older businesses decline, thus resulting in the largest economy that the population will support, which is a prosperous full employment economy. This is what Adam Smith sought to say in The Wealth of Nations, but this meaning was often lost or misconstrued. The unregulated capital markets that existed from 1789 to 1933 continually enabled the real economy to self-organize. Even though venture capitalists generally look at liquidating their investments within a 5-year time horizon, the resulting companies might last for decades or even centuries. The social benefit, to point out the obvious, can continue for a very long time. During this time, these companies will employ large numbers of people and contribute handsomely to the GDP. So, when you look at venture capital in terms of overall value to society, that value has to include all the societal value that a pool of investments will provide throughout the entire lifetime of every company in that pool. Even if some investments fail early on, the final score is so heavily weighted in favor of those that succeed that the failures are insignificant. What is most important in terms of societal benefit is the number and diversity of attempts. This will result in more new industries and more new categories of products and more demand creation. This is why it is worthwhile to allow investors of every type, including banks, to provide venture capital and to create tax incentives to encourage investment in venture capital. Banning venture capital is like banning the planting of crops because some seeds will not germinate and mature. We can take a clue from nature. Every plant or animal must create enough offspring to allow the next generation to survive, even though many of these offspring might die before they can reproduce. Economies are no different, in that every economy must create enough new industries for the economy to survive for the next generation, but those bans on venture capital act as a sort of industrial birth control that causes the new generations to be too small to keep the economy afloat. As Adam Smith argued, human beings have an inborn desire not only to make sure that each succeeding generation of children survives and prospers, but also to make sure that each succeeding generation of industry survives and prospers. The laws that we presently have in place thwart this component of human nature.